shift our attention now to Gitay, who has this company that he's started that uses really looks particularly at stablecoin and the stability of the financial system. Can you see us, by the way, or do you see just me? Who do you see?
I see you. I see the class.
Oh, amazing, amazing. Okay, Gitay, please go ahead. A short introduction about your Genesis block and how you got here and what you're doing, and we look forward to hearing everything.
First of all, thank you, Professor Ilan Alon. I don't know if you know, but in Israel, Professor Alon is a celeb because every time that the mainstream media wants to talk about Bitcoin and about the potential, so they invite him. So everyone really know him. So he's not only a vivid and excellent lecturer, he's also a celebrity. So I honored to be invited by him and talk with you about what we are doing. We are from the Fedz, but it's not a lecture about what we are doing, but more, we will mention it, obviously, but I think as students and researchers, maybe it can show an example of how we can work together from the research economic classic perspective and blockchain and smart contract. It can be a specific example to further discuss about the options and possibilities that we can do. So about myself, my name is Gitay, Gitay Shafran. I am the founder of the Fedz, and as Professor Ilan Alon said, we are trying to improve finance stability and stablecoins by using traditional tools that were already established in the academia, and we try to bring them on chain to serve our purpose and maybe take the whole concept forward. Okay, so specifically we will speak about Diamond-Dybvig model of bank runs and mitigating bank runs and how it correlated and how smart contract can reshape it and bring it to the next level. Okay, let's start. So in 1983, Diamond-Dybvig introduced a model that show how bank runs occur. So in a game theory model that we will shortly review, they show that there is a double equilibrium that depositors in a bank can rather stay and not withdraw the deposit or run. And furthermore, I won't go through all of the list because it's a short lecture, but there are a lot of research that came afterward and improved the model or refer it and refined it. And now we can take it to the next level with smart contracts, as I mentioned before. So what is the Diamond-Dybvig classic model? The story is there is a bank and there are depositors, okay, an ordinary bank, and depositors deposit the money in order to have interest, have a yield when they deposit the money, okay, because and the bank take it and invest it, let's say in a factory in Italy, okay, let's say in Ferrari or some other big factory, and all the depositors are paying to build the new factory through the bank. The bank is intermediary that take the depositors and put the money into work. Okay, but then the depositories, maybe they need the money. Okay, so let's say there are unknown number of depositors, and few of them will need the money in the first period. After, let's say 6 months or 1 month, and few of them will they are patient and they can wait until the factory is already doing his job and manufacture and can bring the money with the yield, with the interest, and pay back all of the rest of the depositors. Okay, so what they showed, Diamond-Dybvig showing the model, there is a dual equilibrium. In the first equilibrium, okay, this is what I described. There is the time, the T0 time when people deposit, all the depositors deposit the money, and then few of the people need in T=1, let's say after 6 months or one year, need the money, and few of them can wait and then get the rest of the money with the return, okay, with interest. So there is a dual equilibrium structure. If all of the depositors or most of the depositors can wait, it's an optimal equilibrium, and everyone receive the money. The early withdrawals can receive the money. The impatient depositors can receive the money, and the rest of the depositors receive the money with an interest, and everyone is happy. The bank is happy, the depositors are happy, and obviously the factory is also receiving his money, and everything is smooth and nice. And this is actually what happens most of the time. But few of the time, there is a bank run. Okay, and the bank run is a phenomena when people think that other people also maybe there are more people that are impatient, and maybe they are patient, but they think that other people will think that other people are impatient and will want the money and withdraw it early. And when that happen in big enough numbers, the depositors can have the money not because of losing the money or because the factory lost the money of the depositors, but simply because of liquidity. They still earn it, everything is okay, but because we need the money, or everyone is expected to have early withdrawals, then the factory cannot complete, the bank need its money, and there is a bank run. Okay, question until this point about the model?
Very clear.
Great. So the most important point in the lecture is not the 1983 model, but the relevancy throughout finance. It's not only a bank and depositors, it is across every finance phenomena, and I'm not saying it. Diamond Douglas from the Diamond-Dybvig couple, when he won the Nobel Prize 3 years ago in 2022, this is what he has to say in this winning lecture.
Because you don't want to throw out the baby with the bathwater, but there are only a few ways of trying to get the best of liquidity creation without having the runs. So one point I like to make whenever I talk in front of non-academics, and for like the last 25 years, except for the word private on there, which I'll tell you why I put it on, private financial crises are everywhere and always due to the problems of short-term debt. So Ben actually just mentions short-term debt runs are what bring down these panics, self-fulfilling prophecy failures. The private sector can cause problems this way. The government has lots of ways to cause problems. So the public financial crises can come from all kinds of things with fiscal policy and things like that. So, and then bank runs are not just about banks. In fact, banks are just one example of the many type of short-term debt financial institutions. Money market mutual funds in both 2008 and in March 2020. Lehman Brothers, we saw that. Stablecoins, Terra and Luna. Short-term securitizations called asset-backed commercial paper. All of these things where they're borrowing short and lending long had meltdowns in multiple financial crises, East Asia financial crisis, lots of things like that. So borrow short, lend long, and illiquid, that's the thing. It's not just about fractional reserves in the banking system. We already sort of understood.
Okay, it's not only about banks. It's also about market money mutuals or even stablecoins. So because of in this year, we have in crypto a very severe accident when Terra and Luna, I'm sure a few of you heard about it, they lost about $40 billion in a bank run and the whole system collapsed. It's a stable coin, and everyone sold the stable coin, and it became not stable anymore because everyone needed the money and the liquidity now. Okay, and not me saying it, Diamond Douglas said it's the same, and I totally agree. And in stable coins, it's even easier to see it. So before I'm talking about how bank runs stablecoins, what is a stablecoin? So a stablecoin is a token that we have on chain. Okay, we have in Ethereum a smart contract, and it represents $1 US worth of value, because this is how it should stay stable, should stay stable. And as long as it is stable, use it as a dollar, right? You can send it through wallets. You don't need the cash that no longer exists in the bank, as Professor Ilan Alon said. You can just simply transfer it, just like Bitcoin or Ethereum. You transfer USDC, USDT, DAI, whatever stablecoin you like, and you can pay with it, and so on. Okay, and bank runs is when the stablecoin loses value, when enough people, impatient people, or people that are patient but think that other people will solve their stablecoin. So there is a panic, there is a bank run, and you can see a list of failed stablecoins when they failed on the promise to stay stable because of a bank run. Okay?
Maybe you can explain, it's easy to understand why an algorithmic stablecoin can collapse. Maybe you can explain why an asset-backed, stablecoin, that you have the money safe for each stablecoin. Why can that collapse?
That's an excellent question. Okay, so yes, I will do it by example. Okay, by providing an example. So the easiest grasp of a stablecoin is a fully collateral 1-for-1 when the stablecoin issuers have dollars in a bank, right, in a bank account, and then he issue for each dollar that he has in the bank, he issue one token of stable, right? So a very famous example is USDT and USDC. Let's talk about Circle, USDC. Circle is an American, fully regulated company that issue USDC as stablecoin, and they have fully collateral of dollar or dollar equivalents in banks. So can they have a bank run? The answer is for sure yes, because as I mentioned before, it's only a matter of if we believe that they have the dollars and the collateral, if the holders believe in it. So about 1 or 1.5 years ago, there was a collapse of a fiat bank in the United States, the Silicon Valley Bank. Okay, they had a bank run, and for our case, Circle, the company, has 25% of the collateral deposit in the bank. So during the weekend, it was unclear if the U.S. government will fulfill and back the depositors' money, and one of them was Circle, the company. So what happened to USDC, the token behind the Circle issue? it depegged also. And you can see the graph here. I just put one of the upright is the graph when USDC collapse. So does that answer the question?
Yes.
Great.
It was a good opportunity to buy, basically.
Yes, but you couldn't know it ex ante, right? You couldn't know it when it happened, because if
If the
you
government
would have the backing,
yes, sure.
if Sickle would have lost 25% of the collateral, what would be the value of the token that they issue? It's unclear. So this is the risk during this period that people grasp if there will be a real money behind the token. Okay, so after we saw the original Diamond-Dybvig model, there is 40 years of research, academic classic research, that trying to improve the equilibrium, a pure mathematical papers and also experiments that tried to show ways to mitigate the risk of bank run or to eliminate it and only keep the non-bank run equilibrium, okay, the stable equilibrium. So Green-Lin in 2003, they suggested an improvement to the mechanism and said, okay, what if it's not an unknown numbers of depositors and they can all run at once? What if we put them in line and allow each of the agents, of the depositors, withdraw only in their turn in a circle staggered withdrawal line? And they prove mathematically that if all are rationals and this is what happening, so they eliminate the bank run equilibrium, because sequential decision making allow the coordination. So it's not in our favor as depositors to withdraw in each case, and we can know it. We can coordinate between the agents and know what every one of the depositor will do, and by doing it, we help the coordination and the non-run equilibrium. So this is just one example of how further research improve the original and show improvement of stability. But one must ask himself, so why still we have in 2023 a bank run, right? If we can eliminate it. And this is also one angle that I want to highlight in what we are doing, because to change the structure of banking deposits and change a contract in banks is very difficult, right? Think about your bank, and when you open a deposit account, they will say, okay, when there is a bank run, or when we will decide you can only withdraw in this and this sequential manner. So it's really hard to do, right? So I'm jumping forward and not continue with examples because it's a short lecture. But what we can see is there are ideas to improve the stability equilibrium, the stability mechanism, but it's hard to implement, right? But blockchain and smart contract is the perfect way to change those contracts and rules, because in smart contracts, we set the rules. And this is exactly what we are doing in the Fedz. We're taking those ideas from the academic research that has been built across the years, and we just translate it into the blockchain smart contract language. We just translate it. It's a translation mechanism, and we take the rules and we write it in smart contract manner. So let's take the Green-Lin concept, it's now easier to do it, right? We can easily program the rules of when people can deposit or withdraw and put it on chain. And when we do it, it's deterministic. We don't need to trust the bank or the government or anyone or us if we can if we will fulfill it or not, because it's on chain and no one can change it. So the rules are known, they are transparent, everyone can see and know what others are doing. Okay, so it's just a perfect way to take this research and implement it and experiment it in a new way. Okay. There are researchers that doing that. We are not the only one from the academic, but it's very narrow. We have a lot of traditional finance and laboratory experiments that have that are doing, and there are a lot of smart contract and entrepreneurs that building stuff on chain, but there are little or almost none interface between them. Okay? So what we are doing is issuing a stablecoin, and that's called FUSD. And by doing so, we are trying to represent and show and experiment those principles that we talked about earlier. What we did is we took liquidity, the deposit, and put it on chain. We talked a little bit about NFT. Ilan, Alon, and you guys had a discussion before about NFT. We issue NFT in order to represent the deposits, and also in order to facilitate the sequential access to the deposit. Okay, so everyone that want to participate and deposit to our stablecoin bank need to have an NFT, our NFT, that serves as a key, as a certificate access to the liquidity. Okay, and then we can also play with it. We can incentivize the non-run equilibrium, a stable equilibrium, and we can manage among ourselves and do the coordination play out, not only in a Green-Lin manner that it is only one example, but implement all ideas and maybe also new ideas. This is how it look like. Okay, so you have NFT, funny pictures that we like. Okay, but more important, it's an ID that only participant can access. We shuffle the turns, and each round, everyone can access the liquidity pool and play. And we can see, we can feel, and we can almost prove it is more stable than the traditional manner. I will leave time to question and discussion. We have only 15 minutes left.
You can finish the presentation if you have anything else to say. I actually think in your case, examples are always good because it's hard to understand the concept for many people.
So maybe speak more about the concept and about the Fed's issuing the FUSD. This is the thing that you want me to dive into.
Yes, and perhaps also if you can give us a kind of a competitive landscape of stablecoin ecosystem, which is
okay.
Of course very
Let's talk about stablecoins. So
and so on. In particular, I want you to talk about one of the things that I just recently read is that scale is a big issue in the stablecoin. At the end of the day, PayPal is not able to reach the kind of scale that USDC and USDT. And PayPal is a big company, right? So you would expect that PayPal stablecoin is going to be extremely big, and yet it seems that this market is very oligopolistic, right? Very few players are controlling most of the stablecoin market. So maybe you can, as your company is trying to kind of break through, like maybe you could sell it as a SaaS, I don't know, but it seems that it seems that it's very competitive landscape, and maybe you can describe that landscape and what each player in that landscape is. What is the added value of each of these players? What is the, you said choose your favorite, USDT, USDC, DAI. Well, what is it? How do I know what my favorite is actually?
Yeah, let's talk about stablecoins and why it's so cool and popular right now, and why we believe it will be even cooler and more popular in the future. So, what is a stablecoin? Stablecoin is like a euro dollar. It's a dollar, but it's not issued by the Fed, the Federal Reserve, and not issued by the banking system in the United States. So the Federal Reserve can control how much money, maybe soft control, but control how much money is printed in the Federal Reserve, in the central bank, and it can control by interest and by capital limitation of how much money is issued by the American banking system, right? But let's say in Europe, in Italy, if a bank provide a dollar loan, so it's a euro dollar, it's a dollar that's being issued, created, but outside the American dollar ledger system, right? Stablecoins are the same. Let's say Tether, okay? They issue a new dollars, an on-chain token of a dollar, but it's out of the control of the American banking system or the central bank in America. So it's the same concept as a euro dollar, and it's not in a state, it's on-chain, okay? This is like a more wide explanation about what is a stablecoin, and there are a few ways to do it. So the original way, or the first thing that was done is Tether, USDT. It's a central entity that, as I mentioned before, they have dollar in the banks. It's not necessarily an American bank. It can be anywhere in the world, and they issue a token when they decide that they need to expand. Okay. By the way, what is their business model? They can invest those dollars in short-term or medium-term bonds, and then they profit from the collateral. Okay. But we in crypto, okay, Professor Alon talk about the Bitcoin guys, right? And the crypto guys. We don't like it. Why we don't like it? Because it's central. Only one entity controlling, and they can decide if they accept our token or not. And maybe it's not even then. If the CEO of Tether receive a call from Trump, let's say, and he said, we want to shut out your business, it's easier to control. So very closely to Tether and USDT, there is an attempt to do it in a decentralized manner. So DAI and MakerDAO is such a form of decentralized stablecoin issuing. What they are doing, they're putting ETH as a collateral, and over collateral what called CDP, a deposit against the stablecoin that everyone can issue. So let's say Professor Alon want to issue $100 of DAI. He can deposit $150 of ETH, okay, Ether, and then he has in a smart contract, and then he has 100 DAI that he can spend or loan or use. So it's a decentralized way to do what Tether do in a centralized manner. That clear?
Yes, well, maybe, take one step further, even back. And why do we even need stablecoin? I mean, we have dollars and euros already. They're so stablecoin. Why do
So a step backward, why do we need it? What is the benefit of a stablecoin? So if I have dollars in my bank account, and I want to transfer it to Professor Alon, but now it's a Saturday, it's a weekend, or even in each and every day of the week, it will take maybe 2 days. It will cost a lot of money. I will need to explain why I need to transfer this money to Professor Alon all of the sudden, because it's the first time and the bank doesn't see the beneficial in the list of people that I already transfer money to, right? So if I have a stable coin, I can pay or send money or receive money on-chain without anyone asking question or controlling it. So now there is European attempt to control more, right? The state want to control our money and control also stable coins, but the concept is if I have it on-chain, it's cheaper, it's faster, it's 24/7 service, okay, it's better.
That's a good explanation, and I think maybe to add to your explanation is the story of the insurance company, right? If you want to create business models, probably it's easier to do on a stable coin than on something that shifts in value from day to day drastically. If you want insurance or whatsoever. Okay, it's a great.
Because the dollar is a few things. It's the token, it's the value of $1. Okay, so our mind are set to use the value of $1, so we can use it also in insurance or any finance application. Okay, because we already used to think in dollar terms. Okay.
I have a question if I have 1 minute.
Yeah, sure.
Okay, thank you. I was already thinking about it yesterday evening after the course, and talking about inflation, moderate inflation makes more spending, right? So people spend money because of the inflation, the money will be worth less in 1 year and 2 years. If we make a stable coin that does not have inflation, or if we make a Bitcoin, which main purpose, if I'm not wrong, is to make payments peer-to-peer, but we're talking always about payments. So if I have no inflation, is not a risk to to shrink the economic growth and the spending of the people?
That if I'm not using a stable coin, but using Bitcoin, let's say?
Yes, this question was about Bitcoin, but after listening
Hearing about the
stablecoin, so I have 2 questions. One, which is the difference if there is this risk using Bitcoin that people would spend less money? Why? Because it's an asset and is inflation proof, so it doesn't affect by inflation. And moreover, it rises its value. So if I have Bitcoins, I will never spend it if I'm not really in need to eat and drink something, because it's money that is growing.
Right. So this is the store of value versus means of exchange, right? I want the money to serve me as maybe as a store of value and to keep it for years. And then the inflation is a penalty, as a tax that I'm paying. And maybe I need it for short term, just to transfer $100 to Professor Ilan Alon. I want just to transfer $100 on chain. So then the inflation is less of a risk, right? Even if it's all the time, for days or weeks, it doesn't matter. So, but to take your question further, there is a wish or attempt or a trend that is very high in stablecoin that it's called yield-bearing stablecoin. So you remember that I talked about Tether and Circle business model that they deposit the dollars, the collateral, and gain interest for the money that is deposited in the banks. So there is attempt and thinking and trend that yield-bearing stablecoins crypto dudes are trying to print, to issue stable coins that give you this interest that pays the holder of the dollars. Think about $100 in the bank account, but it's in your wallet. You can use it as you like, and you get the interest and the yield that is paid by the collateral. So it's also a mechanism that we play with and try to do. The issue with that is again the regulation, because they say, okay, so it's not only a stable coin, a token to use it, it's also an investment vehicle. So the regulation is very challenging in that manner.
And just to maybe give another example, right now in stablecoin, you can get 5%, 6% interest. And you don't have to lock the money for a long period, in, out, whenever you want. And if you go to the Bank of America and you want to deposit in a CD and time deposit account, you know, first of all, you have to lock the money and you get a lot less interest rates. So the stablecoin also allows you to create income or yield that is higher than what the traditional finance does.
Yes, and so even more is inflation proof. So there is no inflation on stablecoin, right? Do I understand well?
Not really, because in stablecoin or stablecoin issuers, they don't control the initial supply of the dollars. They just want to mimic, to track, to peg their token to the US dollar value. So if the US dollar value devaluate or decrease in value because of printing US dollars, so also the stablecoin will appreciate the same, right? In the same value, because we just keep the $1 value.
Yeah, the inflation rate is not controlled by the ecosystem, because the inflation rate is controlled by the sovereign nation state, right? So in that case, the Fed or the United States for US stablecoin.
Yeah, but it's easier. Maybe it's easier for you as a holder or as an issuer to compensate or to have tools, smart contract tools, in order to protect yourself from the inflation.
Okay, and so
But I just want to add one more point, and that is that inflation is like a boiling frog, right? I mean, it's a slow death. You know, right? I mean, when the inflation is only 2-3%, you don't really feel how your value goes down. Over 30 years, you do. When you look back, oh my God, 30 years ago, I bought this house for $100,000, and now it's like $500,000. You see it, then it becomes very clear. There was very massive inflation, but year to year, day to day, unless you're Argentina or some country that lost control over inflation, it's pretty stable. That's the point of stablecoin. You know, it's stable, but it's going down in a stable way, right? Very, very stable, but going down in a stable way. Yes.
Yeah, and just before we finish, I will be happy to answer more questions. But before what I want is to trigger you as students, as researchers, not particularly how we address the stablecoin and Diamond-Dybvig or Liquidity, but in more general, you can take rules, financial rules, and translate it and experiment it and play with it, and there is no limitation for what you can do with the financial tools that is free for anyone to use. Okay.
Yeah, I want to. I have a question. 2 questions actually.
Can you hear her?
Yes.
Okay. First, I was wondering, the stability of the value of the stablecoin is due to the fact that it's backed 1-to-1 with the real dollar, right? But who guarantees that you have the reserves?
Yeah.
And second question is, I don't understand how the stable coin So
Stablecoin. Yeah.
stablecoin has a higher yield compared to the current account, traditional current account. So how do you make it more profitable compared to the current account? How is it possible? Is it for the smart contracts? You were saying something linked to the, I guess, but I don't understand.
I will answer the first question, and then maybe we will recap the second one and try to understand together what exactly.
I'll answer the second question.
Okay, so for the first question, this is for every financial promise. We cannot know. Okay, so let's in the simple form of Tether and Circle, as we mentioned before. Maybe there is no collateral, okay, or part collateral. Tether along the ways, along the years, it's called the Tether FUD, fear, uncertainty, and doubt. Maybe there is no, not enough liquidity one-to-one versus the tokens. We cannot know. And we can see, again, what we mentioned before in Circle accident, in what happened in the Silicon Valley Bank, the same question occur. What if there is no collateral? So you ask, you are right. This is what trigger the bank run or can trigger the fear, and you don't know. But you don't know it also in traditional euro dollar tokens, right? If you have deposit the money in the bank, it's the same. You don't know if actually you know for certainty that
The bank doesn't have it.
the bank doesn't have full collateral. But even if they do, no one can assure it, right? And this is maybe the fundamental aspect of financial instability and what we are dealing with.
There are some technological solution of proof of reserves that are now being discussed, but maybe to your second question. To the first question, first of all, there is now the Trump administration, the first priority for regulation is regulating stablecoins because of exactly this issue, even before regulating all the other strange securitized coins, etc. So this is clearly something that is going to be regulated in the United States, I think, because the US dollar stablecoin is the biggest market. Yeah.
Linked to this, in a traditional bank, at least in Italy, if the bank tomorrow collapses,
It's insurance. Yes.
I mean, I got at maximum 100,000 euros based on my amount. In this case, is there some like insurance about that? Is there an amount that is guaranteed? So if you fail, you fail.
Can you repeat the question?
I'll repeat the question. Just speak a little louder because of the microphone.
Yeah, it's hard.
I'll repeat the question. The question is that in a traditional bank account, you have the guarantees of the government that you're protected to 100,000 or whatever number that is in each country. And what mechanisms exist in stable coins for protection of consumer rights?
So before answering exactly for the question, I want to mention another thing in Diamond-Dybvig original research. They suggested a cure when as you mentioned, the government insure the depositors and then eliminate the run equilibrium, right? If I know that the government will always step forward and rescue the depositors or the bank, so there is no bank run. Okay, there is no reason for me to think that there will be no money. But the problem with that is moral hazard. If I'm doing so and promising everyone that everything will be okay as a government, then the risks that the banks and the depositor can take is infinite, right? I will take as much risk as I can because I know that the government will do it. So we shift the problem from the game theory of banks versus depositors to banks versus central banks versus depositors, but still the problem remains. And specifically, what ensure in stablecoin, this is the same problem. The government think that it's or few of the governments think that it is a threat. So the MiCA compliance are trying to make an order in Europe. The US, as Professor Alon mentioned, also taking a look and thinking about what to do about it. We believe that we should have our own regulation, our own mechanism to ensure stability and not rely on governments or traditional rules, but have native structure that will allow us to issue the stablecoin without the risk of bank runs.
So in a way, to answer your question, that's exactly what his firm is trying to solve. The
Right.
problem of bank runs on stablecoin, the stability of the financial system of stablecoin, that's exactly what his company is doing. That's the value add, right, that his company is doing. Okay, any other questions?
My second question.
Yeah, please. The second question about why is it that stablecoins can provide you with a higher return than the bank in Italy, your local bank? And the quick answer is the middleman is gone. You know, one of the things, I mean, you think about the financial system costs the country, each country, between 0.5% to 1.5% of the total GDP. I mean, it's a massive cost. I mean, you think about your banks and your real estate and the bankers working there and the vacations and the early pension plans that they get. Just happen to have a friend who's a banker who just got an early pension and huge benefits and so on. Who's paying for that? Let me tell you who is. You're paying for that, right? And when you have it on this on the blockchain, it's much more technological solution. It's you cut out all these administration, all this. You're using technology to replace all this infrastructure that costs very much.
Right, and if I may add, also the competition landscape is different because the regulation allowing the banks to charge as much as he believes is a good stability charge. But in crypto, or if it's the landscape of competition is totally open, so if you will suggest 5%, but the economical structure can suggest an offer to the depositors 10%, so obviously the 5% will lose and the 10% will fulfill and thrive.
So what he's saying is that the crypto markets are much
יש
more
סדרה שעוד לא שודרה,
סדרת פשע, נכון?
כן, סדרת פשע, המעצבת שעבדה עליו.
Right. And
any other questions about stablecoin? The opposite of stablecoin, of course, is the CBDC. And that's the central bank currency that is issued by the central bank. And the issues there that it might just can avoid commercial banks. The central bank can actually open deposits directly for people. We talked about the issues, how that's actually very efficient in terms of fiscal policy. If you want to program money, if you want to direct your money to particular industries, if there's crisis. So there is a lot of advantages, but also the big issue with the CBDC is the privacy and control that you're losing. So it's the opposite. The stablecoin is the same solution, that is the dollar solution, fiat solution, but one is through private companies, if you will, and the other one is through the governments.
So, Professor, I will leave you with the CBDC and the future.
Yes.
And I thank you very much for having me.
Thank you. Is it okay to share yours? Can you send me the latest slides? Let me share it with the students. Is that okay with you?
Sure, and I will be happy also to answer questions in private if you have.
That's the best way to reach you.
Visit I will provide all the links, and I'll be happy to have you all in our experiment. Thank you.
Can you take one last question?
You need to be loud.
Yes.
Yeah, sure.
I find it a little bit ironic that in order to have a stable coin, we also have to pay the government money in order to pay to.
What is the question? Start with the question.
I don't think that we can own stablecoin without the real money, the real coins.
It's a remark. It's not a question. The gentleman said that he doesn't think that without collateral we can issue stablecoin, right?
So you don't believe in algorithmic stablecoin, for
No,
example?
I just find this really it's totally based on trust. There's nothing below it.
Like banks.
Everyone just play on trust and then go buy it and then use it to transact and save it.
Okay, it's the last comment. Thank you so much, Gitay.
Thank you. Thank you very much. Bye-bye.
Thank you. Thank you, Gitay.
Yeah.